So, good morning, everyone, and a very warm welcome to all of you to the Paterson PMS quarterly webinar, aptly called Decoding the Stock Markets. Thank you for taking time out on a Saturday morning to tune in. To give you a brief background, Paterson has been operating the portfolio management service since 2003. However, we have enhanced our research capabilities since the start of the year and launched 4 new schemes. The Delta Fund, our first launch, has completed 6 months. The PMS has an investment committee which is headed by Mr. M. Amarnath, Chairman of Paterson Group, and S. Satyanarayanan, CEO of Paterson Securities. I'd like to introduce a few of the other key members who would be talking to you today, who are also part of our investment committee. We start with Prasanna Bitkar, Principal Officer, CIO, and Fund Manager of the Paterson Delta Fund. With more than 20 years of investment experience, Prasanna's career involved being head of research at the iconic Dalal Street Journal. He has also worked in key research roles at Astute Feed, Dalal Times, and Pentad Securities. He's managed equity portfolios of HNI clients at Lohia Securities as well. At Repeating, where he's worked with the rest of our research team members, he manages the Value Migration Fund for small case. This fund has a 3-year CAGR record of 41%. Next, we have Sagar Lele, who is a CFA charter holder, plus a master's in finance from University of Reading in UK, bachelor's in business from Narsi Monji Institute, Mumbai. He spent more than a decade in equity markets across investment advisory, institutional broking, and fund management. His last stint was at Daiwa Asset Management, Japan's second largest AMC, with an AUM of 200 billion US dollars. Prior to Daiwa, he has worked with Motilal Oswal, Antique Stock Broking, and the Wall Street Journal. Prasanna and Sagar will be making the presentation to you today. They will also talk to you about the rest of the research team members and how we work at the Paterson PMS. Prasanna, over to you.
Good morning, everyone. Thank you, Purnima, and thank you everyone for taking out time on Saturday morning. So, thing is, right now we are in a scenario where markets are very confusing. Like last 1 or 2 months, we have seen there's been a lot of volatility, a lot of news flow, and portfolios which actually generated a lot of alpha in last 1 or 2 years are also facing challenges. So in such uncertain scenario, what exactly should be our strategies? What we are trying to solve that query today. Uh, I would like Pratik, if you can start with the presentation, you can share that presentation so we can start with it. Okay, so right now we are having the overview of our funds that we are managing. So there are 4 funds together, and three we have already started. That is Patterson Advantage Fund. It is a large and mid cap fund where we keep large and mid cap as 50-50, and that is managed by our fund manager, Mr. Divinjay. Then there is Patterson Delta Fund, which consists of mid and small cap companies, and it is managed by me. Then there is Patterson Leadership Fund, which is a small cap fund which is managed by Mehul. We are about to launch our Patterson Southern Fund, which is a multi-cap fund. So the idea is like here we are focusing on the south-based companies where we are focusing on very ethical management, good businesses, and where the growth is visible. So we are handpicking few those south-based companies where not many have a breakthrough with management, and with Patterson having a good networking over there, and we are trying to find out hidden kind of gems from the southern part also. So very soon going to launch that. So overall, it gives overall market capability that uh, all kind of large cap, mid caps, and even we can say some thematic funds are included, and we can give a complete uh, bouquet of investment opportunities to our investors. So these are our 4 funds, which and Southern Fund will be managed by Varnath sir and will be also the part of the investment committee. So it will be a complete team efforts which will go into the southern fund. So this is the current overview of our funds that we are going to launch, and we have already started. Next, please. Okay, so this is kind of AUM growth. What we have seen. Look, we are recently like Purnima mentioned that the we have the PMS business going on for more than a decade and all, but we tried focusing on research and then providing complete bouquet of those funds just recently. So May 24, where we started these funds, and Delta was the one which we started. So for 6 months, what we have gone through, you can see that graph with markets moving up and even our number of clients which have gone up and investment amount going up from just 0.65 lakhs, we have gone up now to 45 crore. Look, what happens is the number of addition of client is one part, but overall, even as the fund grows and returns flock in, I guess there is a lot of growth which will be visible in the AUM. But we are just in the nascent stage. We have just started, and we have long way to go. Because what happens, PMS is kind of a business where it's like 3 to 5 years of horizon we need to have. Then we can see a real growth. So I guess we have to give 1, 2, or 3 more quarters where even growth will also be visible, and even returns will be checked how we are performing. So I guess another 2 quarters is where we need to come back to this particular slide. Okay, thank you. The next. Okay, these are our fund performances. Okay, again I will say 6 months is not a period where we can check performances, but yes, we have to show what quarterly performance has been. So Paterson Advantage and Leadership we have recently launched, and around 1 or 3 months we have got the those numbers for. So Advantage Fund is where we have uh, 1 and 3 months both we have outperformed. Similarly in leadership fund as well. We have outperformed. Only delta is where we had earlier invested when market was at high in around September. So a lot of investments had gone. So there is some underperformance visible out there. And we also had kept some amount of cash in delta fund before investing fully getting invested. So that also has played a part. So overall, 1 quarter, I guess Advantage Fund and Leadership have done well, and they are moving up. Even Delta with markets providing good opportunities and we getting fully invested will be catching up soon. So that is what we have the current performance for our three funds. Okay, so let's see what exactly current scenarios. I don't want you to go through all these slides very into detail. I will explain in very simple words. Look, we try to keep it simple. So right now the current scenario, if we look at what are the things? Look, what happens is market is basically looking at the future numbers. Okay. So we need to look at either 6 months or 12 months ahead. Now, if we look at the historical part, what exactly markets have uh, priced in, that we need to check. Okay, we have seen like last week has been a completely miss where there has been a continuous decline, lot of news flows from US. Apart from that, lot of FIS selling has happened. But let's check what exactly market has priced in. So look, there were geopolitical concerns, whether it is Russia Ukraine, whether it is uh, we can we can say what happened in Gaza and all those US getting involved into it and geopolitical concerns. So market has actually priced in that. There are not going to be major impacts of such news on Indian equity markets. Okay. Apart from that, we have to see what exactly poor results what Q2 has been for India. I'll come back to those Q2 results and what exactly we need to expect from for when we go to our next slide and as we go into the presentation ahead. But poor results have been actually priced in a lot of what happened is 21, 20, FY 21, 22, and 23. There was a low base which was created, and hence the growth numbers don't look much better. And Q2 in specific was very poor, as most of the results were below state estimates or analyst expectations. So that is also priced in. Apart from that, lot of uncertainty was there about the state elections, whether it is Jharkhand, Maharashtra, and others. So Maharashtra results are out, impact is visible, even that is priced in. Apart from that, lot of FII selling. I will come to that as well for the next slide also. How much FII selling we have actually seen in and have priced in. And we must understand thus that kind of selling we have not seen in last 5 to 6 years. Despite that, market has moved up. I will show you the graph also what exactly, how much exactly we have Indian markets were able to price in that kind of selling, which is supported by DIY buying. So that part also will come to. Apart from that, we have also priced in that RBI maintained a status quo where everyone was expecting that okay, there will be some rate cut with US going for rate cuts, UK going for rate cuts and everything, and each other country was trying to provide liquidity. But RBI has maintained a status quo, and we are expecting that in February or something. That also comes as to the where to what to expect from market. So that will also come up. So these are major things uh, which are priced in. Okay. Now what happens is what next? Look, as I mentioned, we need to look for 6 months ahead or 12 months ahead. What things are going to come up, and based on that, we need to make up our strategy and our we need to find sectors and schemes and strategies to put up. Okay. Apart from that, there are going to be a lot of macro data that are coming up. Apart from that, a lot of what to say, there are going to be themes which are going to play better than the themes which were which had run up in the past. So we need to change accordingly. Okay. So right now we are in a current scenario where we have mostly priced in results. Now next comes in is the Q3 results. Apart from that, when new budget session is awaited in the month of February, that is the second. And apart from that, lot of liquidity which will be created based on expected rate cuts, and apart from the what additional liquidity measures which are taken by the RBI. Okay. So right now we are in a scenario where lot of selling has happened. Last week was particularly there. Look, we means indices made a high in the month of September. Since then, there has been a continuous decline. There was a marginal upside which we have seen around 24,500 and those levels which where the BSE index, NSE Nifty 50 has gone up to, and then it again came back. So right now we feel there are a lot of factors we need to understand and whether we should invest at current scenario or not. So we'll take up that next. Okay, so what we are looking at. When I mentioned, okay, these are all current short-term scenarios where markets are coming down. A lot of FII selling that happen. Apart from that, poor results happen. These are all short-term scenarios. Okay, we need to look at India as a very long-term story. And as I mentioned, that lot of FI selling has happened, but we are expecting that lot of liquidity will come from FIs. First and most important part is India's weight in the MSCI emerging market index has gone up significantly. So what happens? They have to compulsorily buy India as a story when those index changes happen and new buying comes up. So just look at from 2000 to 2024, the India weight in MSCI emerging market index has increased significantly, and that we feel that lot of foreign money and foreign funds will be coming to India. Now, let's look at how we are placed as compared to other peers or other countries where which are considered as an investment destination. Okay, if we consider it with developed nations or even China, where people were expecting, okay, there is going to be fund shifting happening to China or something. In terms of growth, we are still one of the best place story as compared to developed nation or China also. There are going to be some smaller places where growth would be marginally higher or marginally lower. Then what happens? As we say, we should be happy that we are in India, where there is a lot of depth, there is a lot of length and breadth across the sectors. Look, we have each and every sector where FIS can put up money, and there is a lot of liquidity if they want to go back also. So that kind of opportunity, global players cannot ignore India as an investment destination because the kind of length, breadth, across the sectors we have, the kind of market capitalization we have right now, there is no other country which offers that. Look at kind of sectors, whether it is oil and gas, whether it is manufacturing, services, automobiles, parts, so utilities. Each and every sector has a depth where a lot of money can come in and a lot of more liquidities can be put up in next few years. So that one part, that length and breadth and depth of Indian markets keeps us ahead of all other countries. So that is one. Okay. P ratio may look higher, but then we are a growth story, average, and a lot of index changes also happens, and that changes that P ratio. But I guess we should enjoy some premium over other countries, and that will continue for next 3 to 4 years. But I always say, I mean, I have mentioned a lot of time that India moving from 3 trillion to 5 trillion economy, there are going to be hardly any major declines. Even in past, whenever a country which have made its shift from 3 trillion to 5 trillion economy, not major declines have happened, and there is a market which has flourished. So we are in that particular sweet spot where India is seen as a major growth opportunity. Now, if we look at the Nifty 100 and if you look at the right hand side upper corner, we can see how P ratios of benchmark indices are there, and we see mid cap and small cap have some kind of higher P's where we can see. But again, what happened is overall large cap or mid cap, they have been catching up with fundamentals, and we feel mid cap and small cap soon will catch up with fundamentals with this decline which has happened. So these PE ratios may look higher right now, but a catch up would happen very soon, and we are expecting as rationalization of those fundamentals will happen, and it gives us a good buying opportunity. As for GDP growth and earning growth, as we can see what we have seen in FY 20 to 24, what GDP growth and earnings growth has been. So earning growth has sustained. And look, we must look at this particular EPS and PE growth as one part, that what happens if we are looking at any market or index as an investment part. So what happens? 75% is the PE expansion and 25% is the PE growth. So 75% of the times it's going to the PE expansion, and PE expansion, as earnings improve, there will be further PE expansion happening. So we see a lot of things which can get accommodated, and valuations may seem to be very higher or look stretched, but P expansion happens when markets are growing, and that we expect in India as well. So next slide, please. Okay, now why I'm focusing on the numbers. Look, the worst seems to be behind. Look, if we look at the Nifty sales growth or PAT growth, these are the four charts which we have, which gives Nifty. We have only taken 35 companies out there because there are NBFCs and banks we have excluded because that won't provide a sales growth or PAT growth kind of right thing. So this slide pro is what? Look at last 4 to 6 quarters. Sales growth has been below double digit, and very single digit growth we have seen. Apart from that, PAT growth has also declined. Similarly, EBITDA growth has declined, but margins have been like sustaining like 20 to 19%. So now we feel that most of the negatives are and worst seems to be behind. We expect sales growth to happen because of the base, which we have lower base now from last 1.5 year. Similarly, for PAT growth, if margins are sustained, PAT growth is also expected, and EBITDA growth is we are also expecting to be better for next 2 quarters. Apart from that, a lot of capex has been done by Indian companies in last 2 to 3 quarters, and as a result of that, lot of capacity goes on stream from next 1 or 2 quarters. That sales will also be visible from FY 26 onwards. So lot of growth is expected in terms of manufacturing and uh, some part of services as well. So we feel worst in terms of corporate earnings is behind us. We are at a point where there is no further more decline is expected. We don't expect any negative kind of growth happening. We see a positive growth from here. So worst is behind, and we are expecting a better quarterly results or India Inc. results coming from Q3 FY25 onwards. Okay, there are, look, the major concern which we had is like, as I mentioned, that status quo by RBI, which was maintained. We feel there are the inflation rate is expected with Rabi crop coming up because it was food prices and oil prices, which made a major dent to inflation and to our pockets. But right now, inflation rate, which we feel with Rabi crop coming up and food inflation coming down, that will be cooling off, and crude oil prices have also declined. So that part ahead of budget, we feel a lot of positive news coming from that way. And what happens is uh, taxation, which was again a major part, which was impacting Indian equity investment market, was is now it is being shifted to or postponed to the next budget. So we don't think there is going to be any major negative news coming from on the income tax increase part or direct taxes part, and that is a very much positive for Indian market. So all this combination of three factors, we feel we can expect a rate cut starting from February cycle onwards. And as we start, there is going to be a longer cycle for of rate cuts. And with liquidity coming up with that, overall economy is expected to revive and provide results as a part of that cycle. Okay, one thing is like if we look at what happens is whenever there is a government spending, that yeah, sorry. So this is a growth in government spending. Look, what happens is whenever government spending happens and capital expenditure happens, it comes whenever that investment comes in, it gives a tempo to that cycle, and it again regenerates a lot of capital. So what happens is overall from last 8 years we can see more of capital expenditure has been done and less of grant in aid has happened. So what happens? A lot of regeneration of capital kind of things are invested, and this provides a lot of momentum to investment cycle. So this one factor is very positive with public spending happening more and less of government aid or subsidies being provided. It's a very positive thing for Indian equity market. Okay, look, what happened is like as the participation increases in Indian equity markets, and that provides a lot of sustainability to on a domestic part. Look, in the past we were quite dependent on the FII flows for larger equity kind of investments or liquidity. But look at the kind of demat accounts we have seen on the rise. Okay, now a lot of digital infrastructure development has helped in this. Look, from my mobile also, I can open an account and I can trade, which was not possible earlier. So that technological advantage which has come up now has helped us a lot. So there are now 18.2 crore accounts, demat accounts which are open. Okay, we may see some moderation going ahead with like less number of accounts being opened every month, but I'm not bothered about that because what used to happen earlier was with digital infrastructure not ready. Earlier, the life of any demat account was very shorter, 6 months to 9 months. But now, with these digital things happening, a lot of longevity has come up, and I guess that is a good money from retail part coming to the Indian market. So that is one positive part. Domestic inflows. Look, when we used to like focus on equity markets, a lot of stratum was focusing on taking lower risk and investing into mutual funds. So we have seen a good improvement from 57 lakh crore of AUM in mutual funds to now 68 lakh crore. So that gives a lot of depth. We have seen a larger investment coming from SIPs, which is like 24,000 crore, which are coming as in SIPs, and only SIP AUM is around 13 lakh crore now. So that gives us a base where consistent money is flowing into equity markets. So this provides us with a lot of liquidity and support when foreign money is not coming. I'm not saying, okay, they are going to give us a lot of growth, which can be given by FIS, but again, sustainability is one part which is provided by this increased demat accounts and domestic inflows in the mutual fund industry. Okay, look, these are what more than 5 lakh crore of selling has been witnessed in Indian equity markets, but similar amount is being absorbed by the DIIs. These two figures, look, if we look at 22 and 24, where major FII selling happened, and then DII have been the buyers in similar years. But what exactly happened in market? So the next slide gives me the color exactly what I am trying to say. Next slide, please, Pratik. Look, from 22 to 24, consistent FI selling happened, but Indian markets have absorbed that selling, that 5.7 lakh crore, which was selling that happened and consistently moved up. So I'm not anymore much bothered about FI selling. Yes, there are going to be short-term dips that happens, and my portfolio with higher beta may underperform for a certain period. But if I look at the longer term horizon, like 3 to 5 years, I'm going to generate that alpha and the expected indices. So these are the positive parts. Okay, next slide, please. So there are going to be, look, as I mentioned, there are going to be few positive factors. Long term, we are a growth story where I mentioned that from 3 trillion to 5 trillion, there are not going to be major dips, and any dips that comes in is a buying opportunity. But there are going to be very positive factors. One is inflation. As I mentioned, it is declining. Imports. We are reducing our imports. We are dependency on our crude with declining crude prices, and along with the ethanol, which is the major story playing up now. A lot of imports are going to be, and that gives us a better balance of payment kind of scenario. We have fiscal prudence in place. So our fiscal prudence less than we come to less than 4.9% or something. That is what government is targeting. Despite higher capital spending, that is a very good fiscal prudence which we can look at. And as I mentioned, subsidies are declined and capex has increased. We are expecting a lot of INR and USD kind of stability that we can see as it makes an impact on our complete investment cycle as well. And apart from that, consistent growth from India. As I mentioned, that we have seen that worst is over, and we are expecting only uh, positive takeaways from the India in terms of corporate earnings. Last, we can see that yes, a lot of money which was expected to go to China and FIS flopping back to US because there is a stability which is coming. But look, as I mentioned, lot of sectors are that kind of growth which are expecting, whether it is renewables, whether it is another like services, those sectors are available only in India. So a lot of interest stays in India, and there are a few sectors where more money or liquidity will coming, and that supports. So overall, India story still stays very strong. As I mentioned, rate cuts are expected. Look, rate cuts may seem as a very simple thing to everyone. Okay, 25 basis point cut, and okay, what next? But there is a larger cycle which is dependent on that. A lot of liquidity comes in, a lot of spending happens, and a lot of new opportunities come up with the rate cuts. And as the rate cut cycle starts, very positive for Indian equity. So I guess from February onwards, as the rate cut cycle starts, we can see impact of it coming up in the next 2 quarters as well. Okay, so there are going to be few sectors where we have a positive view, and then there are certain sectors we have negative, not as a negative, but they may underperform or something. So automobiles we had exposure earlier, but we are reducing that, and almost there are only few companies where we have exposure to. Banking with rate cuts and the kind of capex going on, and uh, apart from that, NPS is being reduced. PSU is also contributing to the banking sector. We see a lot of positive in banking. Capital goods, we feel that valuations are a bit high, and we're staying away unless and until the valuation, the fundamentals catch up with valuations, there will be no more allocation to capital goods. Consumer and defense are two sectors we are very positive. Consumer, we may see some kind of slow growth because spending has reduced and a lot of discretionary spends have declined. But again, as I mentioned, Rabi crop happens better, prices getting better there, and rural economy picks up, consumer will be the sector where lot of money will be flowing, because with decline in terms of prices on bourses, lot of good opportunities are lying up in consumer. Defense, again, we had an issue with valuations, but lot of uh, prices have come down, and valuations are catching up. New orders, apart from that, new companies coming up, new age companies coming into defense sector. I guess one sector which we feel is has a longer term scenario and longer running opportunity is defense. Engineering also, we have valuation kind of issues, and with legacy orders and few earlier orders still lying in their books, unless and until new orders start flowing in with better margins, we are staying up. For finance and healthcare, we have still exposure. NBFCs and MFIs we are avoiding right now in terms of finance, but other finance companies where gold loans and all are there, they are looking better placed in terms of valuation. Infrastructure, we have neutral stance and same as materials. Uh, Internet is what we can say. Yes, valuation is one part again comes up, but there are new age companies where we are positive, and as we get good prices, we look, we cannot time it exactly, but we have prices in mind and we can price it. So we are looking at those prices, and as we get investment opportunities at those prices, we are looking at those opportunities also. Technology, we are positive. IT and technology, both we are positive, because as INR gets stable, and even earnings from their what we can say earning visibility comes from US in terms of larger NBFCs and banks from there. So that looks very positive. So larger orders and all will be coming up, and that gives us a positive view on technology. We have pharma as well, means in particular for healthcare, we have pharma where we see larger opportunities coming up. Few mid cap and small companies are looking good. Large cap also are there, but again, seem fully valued. But mid cap in pharma are looking good, and we are looking at few of the opportunities. Okay, so these are the sectors where we have mentioned that we have a positive view. So these are six sectors we are looking at. But again, we are looking at larger leaders from this particular industry. Yes, there are going to be some small cap or mid cap companies which people even don't have heard about, have not heard about, but looks at a very hidden kind of gem. We have few companies which are under our orbit for research. So let's see what new opportunities come in defense and even in healthcare and consumer. Okay, so this is what our view is, but overall we feel that current scenario, when our markets are coming means very we can say volatile, may deter you from making investments. But a very simple idea of investment suggests is like someone is asked me, okay, when to invest. So we only suggest whenever you have money. So that we cannot time the market. But yes, there are going to be good opportunities. Valuation wise, market is providing us that opportunities right now. And if we are able to find those gems at a right price, I guess next 1 or 2 years are going to be very positive in terms of returns. Look, what happened is that people have, as I'm not very uh, I'm not just suggesting that we are expecting very high returns or kind, but last 3 years Indian markets have seen only one way move. Okay, and that results into a lot of we should not expect similar kind of scenario which is going ahead. But yes, even if we try to make out what higher double digit kind of returns from markets, that is one what one can expect, and will be happy to generate that kind of risk. So look, we cannot expect, okay, I can double my money in equity markets immediate basis. Right now, if I am able to beat the risk-free return by 500 basis points or something like that, I'll be more than happy to provide it. So we must sink in with that kind of expectations from markets. So that kind of scenario we are. But yes, if we keep it running for longer period of time, a lot of opportunities are there, and I guess we'll be able to meet our financial goals which we are expecting from equity markets. Okay. So thank you for listening to me with patience. So any queries or something you have, I can answer that.
So we'll open the floor for questions. We've got Prasanna, myself, and Purnima available to answer anything, whether it's the markets or Paterson in general or the PMS, anything at all. You're free to ask away.
Sir, good morning, sir. Sir, I have query.
Yes.
Sir, Indian states are all 80% of Indian states are debt. Only Delhi and is debit free. So the internal structure of Indian government are one way is going down and central government is wealthy. This difference will not dent us our growth, sir.
Look, I don't feel that right now till date a lot of states were having different kind of governments. Okay, so one center was different and state was different. But a lot of alignment has already occurred, and in terms of government spending, whether it is state or central government, lot of sinking has already happened. There are going to be few exceptions where state governments are not supportive or are helping out, or center is providing help to those state governments. But as a larger investment cycle, which we see as a public expenditure, it comes from central, and I'm not bothered. Or as an investor or investment capability, as an investment team, you are not much focused on what states are doing because it's a smaller part of what centers are doing. So I don't feel there is going to be any major impact of if there is no major thing, or mostly states are under debt, or they are running all these subsidies program. I don't think it's very long term scenario, or it is very sustainable thing. And once that thing happens, I guess it's cycle of, look, we have to look at next 20 years, not next 5 years, where state government can be changed and with new thing coming up, that one nation, one election is coming out. So I guess that provides a lot of visibility in terms of center and state going into sync. Yes, for next 5 years, there are going to be some uncertainties in terms of state, or what we can say, center not getting aligned. But overall, I don't feel that it will make a major impact on equities.
Yeah, so good morning, sir. This is Jyoti from Tirupati branch manager, sir. Yeah, sir, can we go for any short term or long term as of now from that downfall market, sir? Can we go for any short term delivery, sir, in equity? Having any further correction is there, or can we enter in on that market, sir, as of now?
Okay, sorry. Okay, I think we've lost Prasanna here. So I'll try to answer that. What we've been recommending to clients across multiple products is that the markets have been range bound or downward for the last couple of months.
Yes,
So
sir.
we've been recommending clients to keep some cash aside as ammunition to invest in the markets whenever there is a downfall. Now our view is that up until February, the markets are expected to continue being range bound. There are some pressures that are still expected to hit us in the near term. And February onwards, you can expect a more firm direction on the markets. And that's because there are two major triggers coming up in February. You've got the fiscal budget as well as the monetary policy announcement.
Yes.
So until then, we expect some amount of volatility to continue. So our recommendation usually to investors is that you keep some dry powder aside. And whenever you see that the markets have fallen, like in this week, for example, you
Yes.
invest a part of your ammunition into the markets. So if you've kept, say, 100 rupees aside, invest 20 each time when the markets are falling to make
Buy
the
and dip,
out
yes,
of
sir.
this
Buy and
period.
dip. We go for buy and dip, na, sir?
Yes, that's what we're
Okay.
recommending. Yeah.
Yeah, okay. And one more doubt, sir. For the PMS presentation, what are the percentage we are expecting for the quarter or annual, sir?
In terms of returns?
Returns, exactly, sir. Returns.
The PMS is a slightly longer term product, right? We're looking at investors. We usually encourage them to look at us from a 3 to 5 year standpoint. If you're investing in the PMS or in the equity markets, I think it is very incorrect to start looking at a quarter or annual returns. I think the last 3 to 4 years, markets have been very consistently upwards, and that has spoiled us a little bit. But if you go back in time and look at analyze 10 years, 15 years, then we need to stick around for longer periods. So at Paterson PMS, what we aim for is that over 3 to 5 year periods, we want to significantly beat the benchmark. And the way we look at it is that historically, the Nifty 50, for example, has a 10-year CAGR of about 13 to 14%. So inclusive of fees, we want to deliver at least 500 bips above the benchmark on a long-term sustained basis. So I would highly discourage to look at shorter periods, quarters, 1 year, etc. We need to assess this from a 5 year plus standpoint.
Hi, Abhishek, this side. So my question regarding the we mentioned that there might be rate cuts in the Fab in from the RBI, and at the same side, if we look at the Fed's commentary over there, there will be a less hope of the rate cuts. So what is your take on that in terms of maybe there will be minor corrections, but will that impact a lot on the Indian market if there is a very less correction we are expecting, or are we expecting more correction compared to Fed, and which will give us a more booster in terms of growth?
Look, so when we are looking at, as I mentioned in presentation as well, uh, the kind of length, breadth, and depth Indian markets provide. So it should be looked as an independent market. I'm not very bothered about what look, globally. Yes, we are connected, and we have seen uh, impact of global events. The kind of revival Indian markets have witnessed as compared to the other global markets has been much better in last few years, and should be looked at as an independent market. And yes, there are going to be positives which are coming from rate cuts from US or even other developed nations. As the Indian rate cut cycle starts, we get a major booster, and uh, cannot be seen in a connect with what cautious stance or rate cut slowing down, rate cut cycle slowing down in US markets. Whatever I am expecting is like majorly focused on Indian rate cuts, providing lot of liquidity and lot of growth opportunities and capex again starting up, and that providing a booster to the Indian corporate results, Indian results. So that cycle I'm looking at. Yes, there are going to be temporary bleeps when foreign news flow comes in, but I'll take it more of a opportunity to add or average out for few of the things where we have already missed out, and then we're trying to generate that additional alpha for our portfolios. So that I will see it is independent as an independent activity rather than connecting those two things.
Sorry, just to add to that, Abhishek, what we've also seen is that if you go back to what happened in the end of 2021, when inflation picked up globally, right, and all central banks were increasing rates, including India. But what we saw at that time was that the Indian growth story still continued, and our relative growth was much higher compared to the world. What happens in such a case is that monetary policy is not the only factor, but the fiscal policy also comes into play. Government spending was very aggressive at that time, and that supported a lot of growth. So even this time around, I think it's not correct to only compare the monetary policy of a certain other country and India. We also need to look at the fact that government spending has been on a lull for the last 2 years because of elections. And that expectation is also of a revival starting sometime next year. So the Feb budget will actually give you a glimpse of how that spending is reviving, and it doesn't need to revive very aggressively. The base itself of the last 2 years is very small. So even if monetary policy is cutting, sort of RBI is cutting rates by 25 whips, you will see a lot of fiscal support as well, which is not the case with most global economies. So I think India, you need to look at it from a slightly different perspective of a combination of fiscal and monetary policy.
I have another question. So regarding the valuations of small cap and large cap right now. So there are lot of corrections happening in the large cap and which is not happening in the small cap or mid cap. So what is your take on that? So do you see revival coming in Fab? Then they will be like revival only in the large cap, or do you see the revival also coming in or the growth will start continuing on the small cap and mid cap as well with this?
Yeah, I'll take it up. Look, as I mentioned that during presentation also I mentioned that there are going to be some pockets where valuations in mid cap and small cap look stretched. What happens as the rate cut cycle happens and liquidity is coming back? So a lot of capex happen, and mid cap and small cap are the companies where uh, they are the most they stand to be the major beneficiaries of such revival and rate cut cycle. Yes, as I mentioned, last 4 to 6 quarters, India Inc. Performance in terms of earnings has not been good, but revival would start from December 2024 quarter, and that brings up a lot of parity in terms of valuation as compared to mid cap or small cap in small cap as well. So I guess we have to wait for 1 quarter or 2 quarters where valuation gap is filled up and they catch up with fundamentals very soon. Yes, there are pockets, as I mentioned. Yes, there are going to be few pockets where valuations are high. But then, in terms of picking up small cap and mid cap, we have to be very, very careful. And as an investment committee, when we look into all those such opportunities, we look at management qualities, business sustainability, scalabilities. So all those factors come up. And even, I mean, among those sectors or that particular mid cap or small cap opportunities, we pick up leaders. So that kind of cautiousness and awareness, if kept, a lot of opportunities are available in mid cap and small cap. And there is a lot of gap will be filled up in terms of fundamental catching up in next 2 quarters. So revival part, what happens is people try to invest in mid cap and small cap as the growth rates are expected to be higher and all. And large cap provides more of a, we can say, shock absorbers. They play as a shock absorbers. So not much I'm expecting from large cap, yes, but mid cap and small cap as fundamentals improve, we are going to get major opportunities in that segment.
And what is the reason that large cap is falling more compared to small cap and mid cap, which is like, a very opposite scenario if you compare with the previous downfalls?
No, we cannot say exactly that. If we look at the chart, like index based, we can see those whether mid cap or small cap. Fall has been almost similar in all those segments. We cannot say yes. There are going to be few I will give an example. Like this is the first year when yearly returns for Reliance are going to be in terms of negative. Okay, so there are certain pockets where index weightage have are higher or a lot of selling has happened in those sectors. Yes, we can say that benchmark indices are there where uh, some minor kind of underperformance has happened. But I cannot say that yes, large caps are falling more or mid caps are declining less. Uh,
I think it is the true scenario. If you pull out the Nifty 50, all the companies and share their check their correction from their 52-week high, it is more than what you see in the mid cap indexes. You can pick mid cap 100 stock and see there is not even there are very less stocks which have corrected more than 10 or 15%, and but in the large cap it is just opposite to that.
No, again, we have to see. Look, if I only look at index, then it can be taken as a very apple to apple kind of comparison. For me, large cap is like first 100, then mid cap is next 101 to 250, and then small cap. So, lot of declines are unseen where we can see, yes, just because they are part of index and have declined less, or there is less liquidity, or majorly held by a few of the mutual funds where they won't, there will be not much trading happening. These are few factors that impact that particular performance, especially during December quarter, where their mutual funds have to show their mid cap and small cap kind of mutual fund performances. So I don't think that it can be seen as an apple to apple comparison. That is what my idea at looking at it.
Sir, last question, sir.
Yeah.
I'm Qasim Khan from
Yes.
Tirupati branch. Sir, so far 6 lakh crores are received by the DAs by selling by FIs. Still more, how much we can, sir? Like another 5 lakh crores selling means can sustain the fact, sir, that we are able to generate that much amount. We can trust Indian side, domestic flows.
Yes, look, as I mentioned there, earlier, if we look at retail kind of money which was coming into either direct equity or even through DIs or mutual funds or we can say insurance companies, was not very dependable part. But with technology happening, taking place, improving a lot of sustainability has come up. So earlier, the largest, like the longest duration was for any new demat account was like 6 to 9 months. Now it is running longer. Liquidity is lot of coming up. SIPs are still maintained. So I don't think uh, there is going to be any decline. Look, if you look at mutual fund kind of market right now, it's like as I mentioned, 68 lakh crore. But when it will be like around 95 lakh crore to 99 lakh crore, which is expected in 25, 26, just look at the impact which it will create on equity market. Apart from that, lot of discussions are happening in terms of pension, more many pension funds coming up, and more. And apart from that, what happened is people have understood if they stay longer, returns are much better than other physical assets which were traditional kind of assets. So that awareness, which is going down all the not only T30 cities, even in T3, T4 cities where a lot of youngsters or people who are just started earning are putting up money early as compared to what used to happen earlier. So those things are very positive. I don't think we should look at it as a negative factor. Okay, what if it suddenly stops? We are not expecting that anything that stops. And I will give you just a number. Look, if right now in India we only have some 45 or 46 asset management companies which are running mutual funds. In US and China, it's much more than 5,000 or 6,000. So we are in a nascent stage, we are in a growth stage, and that gives us a lot of opportunity for financial markets to flourish. So this liquidity is going to stay there and support markets. So I don't feel that is going to like dry up very soon. It's a longer term scenario, and we expect that to continue.
These days, we also don't see the kind of spooking that used to come from retail markets earlier. Whenever there used to be a fall, to get completely freaked out and they used to start rapidly selling. These days, the money seems to be much more sticky compared to that. So I think awareness also is a major factor that has gone up into making sure that people are not exiting during turbulent times.
Well, if you have more questions, you can always write into us.
Ma'am, this is
Please.
Manigandan here from Chennai. So few of our clients also joined in the Zoom. So from the fund management team, you can tell some kind of positive notes on PMS side. So they are existing investors on some other company PMS is an AF2. So we can tell some kind of few highlights, kind of a confidence they will we can create. So the clients will look for Paterson PMS too.
Great. I think we can wrap it up then.
Yeah, sure. So thank you everyone for attending the webinar. We'd like to reiterate, like Sagar and Prasanna have mentioned, that at the Paterson PMS, we are in for the long-term wealth creation for our clients. We are not looking at 20%, 15%, or these kind of number growth, but more in multiples. We want to see that the multiples happen for the clients' portfolios. And this can be achieved because of the stock pick and across different sectors, which they're monitoring very, very finely. And this is our promise to the clients that we will help you grow your money, and not with short-term effect, but with a long-term purview and a long-term horizon. And we will look at only fundamentally strong stocks, so that in case there are any mishaps in the markets also, you don't have to worry. And we are here in the long term, and we are here to handhold you through your investment experience and your journey. So any further information, please contact us. You can write into us, visit our website, patersonpms.com. Thank you so much once again. Thank you, Prasanna, Sagar, and all of you who have attended. If anyone would like a recording,
Thank
we
you.
could send that to you as well.
Thank you. Feel free to connect to us through emails or something if you have any certain queries, and we will be happy to answer all those queries.
Okay, thank you.
Thanks
See you
a
on
lot.
the
Thank
next
you.
webinar next quarter. Thank you very much.
Thank you,
Thank you.
everyone. Have a nice weekend.